Warren Buffett once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." This quote captures the essence of his approach to investing. Planting seeds of wealth and letting them grow over time. Warren Buffett is a master of making money, and he has a lot to teach us about how to invest wisely in a changing world. As we continue to explore 2024, a year that may offer many opportunities for smart investors, we want to share with you 5 practical and easy-to-follow strategies inspired by Buffett's philosophy. This guide is not about chasing quick riches, but about making sound strategic decisions and allowing patience to turn a modest sum into a substantial financial cushion. Each of the 5 steps is based on the principles that have made Buffett a legend in the investment world. Let's start with step 1. The stock market, Buffett's favorite strategy. The stock market is a place where you can buy and sell pieces of companies, called stocks or shares. When you buy a stock, you essentially own a small part of that company. If the company does well, the value of your stock can go up, showing the potential for growth in the stock market. It's an investment in the successes of these companies. Starting with $1,000, it's important to have realistic expectations. The stock market can be rewarding, but it's not a surefire way to make money fast. $1,000 can grow over time. Much like planting a tree, you won't see immediate results, but with patience and the right conditions, it can thrive. For example, let's say you invest your $1,000 in the stock market in a company like Tesla, or any other company that has had a good year, with a value increase of more than 10%. This means that you'll have a return of around $100 that year. This return may not seem impressive, especially considering that it depends on your initial investment. So, what's the catch here? As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. He is a long-term investor himself, as you can see from his stake in Coca-Cola since 1988. Long-term investing is the way to go in the stock market. For instance, $1,000 in the same stock market. Let's say a company that grows on average 10% every year and pays a dividend of around 4%, which also grows 5% every year. With this in mind, same $1,000 investment after 30 years will be worth $36,960. So, instead of making just $100 in 1 year, if you divide $36,960 by 30, you would have made around $1,232 every year from your initial investment of $1,000. That's over a 102% profit instead of just 10% every year, simply because he was patient. And you can achieve those numbers with companies like Tesla, Lowe's, and Home Depot. Investing in stocks comes with its share of excitement and risks. Stock prices change based on various factors, such as the company's performance, the overall economy, and global events. However, the rewards can be significant for those who are patient and make informed decisions. It's about finding the right balance between risk and potential growth. That's why Warren Buffett stresses the importance of knowledge. Risk comes from not knowing what you're doing. He said, being well informed about your investments greatly reduces risk. One of the key principles that Warren Buffett follows is to invest in a company because you have confidence in its long-term prospects, not just because you hope the stock price will go up. But he also recognizes that there are other options for investing your money that are safer and more predictable, such as savings accounts and CDs. These are common ways to save money and earn some interest from the bank. Savings accounts are very simple. You deposit your money, and the bank pays you a small percentage of interest every year. CDs are slightly different. They are like savings accounts that you lock for a certain period of time, such as 5 years, and in exchange you get a higher interest rate. For example, with a 1.5% interest rate on a CD, your $1,000 can grow to about $1,078 in 5 years. It's not a huge increase, but it's safe and steady. Over the long term, it may not grow to $30,000, but it will be protected from market fluctuations. So another strategy you can use is to take advantage of the high and low cycles of the stock market. When the stock market is high, you can sell some of your stocks and put the money in CDs. When the stock market is low, you can buy more stocks at a discount and use the money from the CDs. This way, you can combine Step 1 and Step 2 to reach your ultimate goal of $30,000 or more. Just like Buffett said, don't put all your eggs in one basket. This shows the importance of diversification, spreading your money across different types of investments, some riskier and some safer. It's about finding the right balance between the potential for high returns and the security of having some stable, low-risk investments. The next one, and probably the most rewarding in terms of value, according to Buffett, is investing in yourself. Investing in yourself may be the best use of your $1,000, something that Buffett strongly supports. He says that the best investment you can make is in yourself. This is because the skills and knowledge you acquire can lead to significant increases in your income potential over time. One way to invest in yourself is through education, such as taking courses or attending workshops. Imagine using your $1,000 to enroll in a course in digital marketing or coding. These are skills that are in high demand and can open up new career opportunities or allow you to start a side hustle. For example, learning web development could enable you to create websites for clients, potentially earning much more than your initial investment. And then, you can use that money to invest in Steps 1 and Step 2. Another example is investing in a course that teaches you about the stock market or real estate investing. This knowledge could empower you to make more informed and profitable investment decisions in the future, potentially multiplying your initial $1,000 many times over as you apply what you've learned to your investment strategies. The more you learn and improve your abilities, the more valuable you become in the job market or your own business ventures. This is not just about making more money. It's about becoming more. By investing in yourself, you're opening doors to opportunities that can multiply your initial investment many times over, both financially and personally. One of the key strategies for managing your investments is to diversify them across different types of assets. This way, you can reduce your risk and increase your potential returns. With $1,000, you can explore two powerful ways to diversify your portfolio: index funds and real estate investments. Index funds are a type of investment fund that follows the performance of a specific market index, such as the S&P 500. Instead of choosing individual stocks, you are investing in a wide range of companies. This diversification lowers your risk because your investment is not dependent on the success of a single company. For example, if you invest your $1,000 in an S&P 500 index fund, you are essentially owning a small fraction of 500 different companies. Over time, this collection of investments can grow, potentially multiplying your initial investment. Warren Buffett is a strong supporter of index funds because of their simplicity and effectiveness. He once said, "A low-cost index fund is the most sensible equity investment for the great majority of investors." Real estate, on the other hand, offers a tangible investment that can be accessed with a smaller amount, such as $1,000. Real estate investment trusts, REITs, and real estate crowdfunding platforms are two easy ways to invest in property without needing the large capital that is usually required to buy real estate. REITs are companies that own or finance income-producing real estate, and by investing in them, you earn a share of the income generated. Crowdfunding platforms, meanwhile, allow you to pool your money with other investors to fund real estate projects. Both options can potentially offer higher returns than traditional savings, with the added benefit of diversification. And finally, and perhaps the most important step, Step 5, debt management as an investment. Managing and paying off debts can be an unexpected but highly effective form of investment. When you use your $1,000 to reduce or eliminate debts, you are not only saving on interest, but also securing financial freedom and stability for the future. Paying off debts early, especially those with high interest rates, can save you a significant amount of money in the long run. For instance, if you have a credit card debt of $1,000 at an 18% annual interest rate, paying it off right away saves you $180 in interest over a year. This is effectively an 18% return on your investment, which is a rate hard to guarantee in most traditional investments, such as stocks, CDs, or any other volatile investment. Reducing debts is the same as earning a guaranteed return of the interest you would have otherwise paid. Warren Buffett emphasizes this by saying, "The first rule of an investment is don't lose money, and the second rule of an investment is don't forget the first rule, and that's all the rules there are." By paying off debts, you are following this principle, ensuring you are not losing money to interest. When managing and paying off debts, it is essential to approach the process with both a financial and emotional perspective. A practical first step is to address debts that are emotionally stressful, such as money borrowed from friends or family. Clearing these debts first can provide significant emotional relief, even if they are not the highest in interest. This sense of freedom and reduced worry is invaluable and can set a positive tone for further financial management. After clearing the debts that are causing you emotional distress, such as those from friends or family, the next step is to tackle the debts with the highest interest rates. However, it's advisable to use only half of your available funds for this purpose. The reason is that while it's important to lower your high-interest debts, it's equally important to invest in your personal growth and development. For example, using the other half of your funds to acquire new skills or improve existing ones can be a smart move. This investment in self-improvement can lead to increased income potential, which in the long term can be more beneficial financially. Adding these strategies to your plan can make a significant difference. By paying off debts that are emotionally draining, you can reduce a lot of stress early in the process. Then, by balancing the repayment of high-interest debts with self-investment, you create a dual path of financial improvement. This approach not only helps you become debt-free faster, but it also prepares you for better financial opportunities in the future. So, while using your $1,000 mainly for debt repayment might not seem like a conventional investment strategy, it's a wise and balanced financial move. It's about freeing yourself from both emotional and financial burdens, and then channeling your resources to enhance your skills and income potential. This approach effectively multiplies the impact of your initial $1,000, setting a strong foundation for a more secure financial future. Maybe you have more than $1,000 in funds to invest and want to get paid every week starting next week.